What's up, everyone? It's Karthik with Money West. The day has finally come. After 5 years, we're going to get the first interest rate cut from the Federal Reserve. It's a big, memorable, historic day in the markets because if you witness a Federal Reserve pivot, it's definitely something to take note of because they don't do it very often, as we already know. And an interest rate cut or an interest rate hike in general is a big sort of market moving event and a very, very big piece of the overall economic puzzle. So hope you all are doing great. This is most likely going to be a very, very long live stream because not only do we have the market open, but we also have the FOMC press conference. 2 p.m. Eastern is when the statement is going to be released, as well as the summary of economic projections. And at 2:30 p.m. Eastern, of course, we've got Jerome Powell and the Federal Reserve as well. So we're going to get a lot of insight into how the markets are going to react, what kind of numbers are we going to get. And I think a very, very important stuff is going to be the summary of economic projections. So pre-market right now, as it stands, we've got QQQs up over 27 basis points. So we did roll over a little bit and then push right back up. S&P 500 also very, very flat. It's the calm before the storm. And NVIDIA is at $115.73. Just basically flat, up over 11 basis points. And Tesla is up over 66 basis points as well. Going over to some other stocks. Before we get there, this right here is the federal funds rate sitting at 5.3%. This is what's going to come down, and that's what's been priced into the market by 50 basis points is what the markets are pretty much pricing in. So Jerome Powell has got a huge decision to make, whether it's going to be 25 or 50. We'll find out in about 5 hours or so. But this, again, is the most important decision. And, a lot of people are also forecasting that it's going to be a nothing burger or it's going to be not that important. Well, the U.S. powers 25% of the world GDP, right? So it's a very, very important economic player when it comes to the global GDP. And the interest rate within the U.S. is a very important metric to how consumers, investors behave, and even businesses and companies behave. So this is probably one of the most important financial economic decisions in the world, I should say, right? So this really is, Fong might says Super Bowl day. Jerome will throw an interception. So it might actually be a Super Bowl type of day for the economy, for the world in terms of finances and money, because everything is pegged against, the interbanking rate, which is what the Federal Reserve sets between banks. So that's what we're going to get later today. And, guys, make sure that you also subscribe to the channel. And if you can get to 84,000, I will continue to be live. And it's going to be a much longer live stream. So we're trying to get to 84,000. Also do participate in the poll. We've got a poll going on right now. 156 votes right now. We're trying to get to at least a couple thousand votes. So do participate because this is going to be a very long live stream. And we'll see what kind of expectations you have. Right now, 58% of you, 58%, more than half of you are expecting a 25 basis point cut, which is going to be less than what the markets are pricing in right now. We still are at 65% for 50 basis point cut here. And on our poll, we're only at 33%. So on our poll, we're a little bit 34, 57. The markets are expecting 35, 65. And that exactly is what I'm talking about, folks. Nobody really knows what that number is going to look like. So this could actually come as a pretty big surprise. It could come as a very big surprise because, half the people are really going to be surprised, right? If you really think about it, because in our previous meetings, we've talked about how, 90% probability or 80% probability or as much as 100% probability the Federal Reserve is going to keep rates where they are, raise them 25, raise them 50, right? It's been very, very one-sided. But because this is not an equal split, but still 65-35 is a pretty big, discrepancy. And, even if in our polls, we got a 50-33, and then as early as a couple days ago, we were expecting for a 50-50 split. So if you come over to the comparison here, you'll notice how quickly these probabilities have shifted. Just about a week ago, we only had a 14% probability that the Federal Reserve was going to do 50 basis points and over a 86% for 25 basis points. And that number has dropped down to 36% and to now 37%, which is where it is at the moment. And of course, this number has increased to 63%. At one point, it was also 50-50. So it was at around 60-40 and 50-50 around those numbers. I remember doing a couple of videos about it. So, half the population, half the market is still going to be surprised with whatever the Federal Reserve comes out with because, as you can see, 25 or 50, we still don't know. And this has been one of the most uncertain FOMC meetings in history. On record, this has been the most uncertain FOMC since the data began in 2015. And that again is a pretty historic meeting here that we're going to witness, right? So that's why I want you guys to share this live stream with everyone, your friends, family, traders, investors, in your other WhatsApp groups, Facebook groups, Telegram channels, Discords, everywhere. Just blow up this live stream so we can have more and more people join us to take a look at what the Federal Reserve is going to do. This is, again, the most uncertain meeting that we're about to witness on record, where market is still undecided on whether we're going to see 25 or 50. Even you can see the polls here, we're very undecided. With 200 people voted already, still we cannot come to a unanimous understanding of what the Federal Reserve is going to do. As I mentioned before, and I think the reason why we may be a little bit more tilted on the 57%, 25 basis points is because of what my views have been. I think 25 basis points is where I would slightly give an edge to 25 basis points. The reason being is because I'm kind of holding on to what Jerome Powell has mentioned in his previous speeches and FOMC press conferences. He's taken a page off of Paul Volcker from the Great Inflation 1980s. He's mentioned that they want to move slow and steady. They want to move, at a very stable sort of pace where they don't risk getting inflation out of control again, right? They've worked very hard. They've done a really good job in bringing inflation down and putting it back in the bottle, right? So once it got out of the genie's bottle here, essentially exploded to 9%. So they've done a very good job in bringing it back down. So the last thing they want is to cut interest rates so aggressively or so fast that inflation starts to skyrocket once again. And as I mentioned before, you can always dial up, but you can't dial down, right? So with that mentality, I think it's always necessary, or it's always important to start slow, and then you can always dial up if things start to worsen or weaken from here. But it's going to be a lot more difficult to dial down. If they already go up 50 basis points in rate cuts today, in the next few meetings, if they go up to another 25 or 50 basis points, and if inflation starts to accelerate back up, well, then we're going to be switching back to quantitative tightening, right? So that's the last thing the Federal Reserve wants to do, is kind of keep switching back and forth between QE and QT and kind of be in this rock and a hard place and what to do, right? Whether to support recession or whether to support inflation. And yes, that was the toothpaste analogy that I gave you guys yesterday, which was, if you're brushing your teeth, you take out toothpaste from the tube to put it on your brush, you take out a little bit, you can always add more. But if you take out too much, then, you can't put it back in the tube. Maybe you can. I don't know. Maybe some people have special talent. But the point is they can always dial up. You can never dial down. And I think for those reasons, I'm somewhat leaning a little bit more towards 25 basis points. I see I've convinced another 2% people here. That vote's gone from 58 to 60% now, the 25 basis point cut. But again, we'll find out here in about 5 hours or so, just under 5 hours, is when the statement is going to be released. The statement, and the most important thing is actually not even going to be the statement. The statement, of course, is going to give us a little bit more of an insight on 25 versus 50. But the most important is actually going to be the summary of economic projections, because we're going to get that summary of economic projections after 3 months. The last one we got was back in June. So July, August, and now it's September that we're going to get those revisions for the projected material. So Alistair says, wouldn't be surprised to see 0.75, 75 basis points. Surprise everybody. Not just half the population. Jerome Powell's like, I want to surprise everyone. Doesn't matter. 75 basis point cut. Here we go. I mean, Elizabeth Warren did want a 75 basis points. I mean, I don't know how seriously he's going to take them. But this right here was the letter that Elizabeth Warren and a few other senators, Sheldon, White House, John, sent to Jerome Powell. So pretty much the Honorable Jerome Powell. This was a couple of days ago. We write today to urge the Federal Reserve to cut federal funds rate currently at 2-decade high of 5.3% by 75 basis points is what they were urging the Fed to do. And I see that we do have 2% of our votes on 75 basis point cuts. I mean, that would just be, in my opinion, unnecessary. I mean, it would be a little too much, I feel, because as I've also mentioned before, that the risk of cutting too early is greater than the risk of cutting too late. What does that mean? Because I've said this many times in my videos before. The risk of cutting too early exceeds the risk of cutting too late. And once again, it goes back to our discussion. What is it that the Federal Reserve can do faster? You guys answer that question. What is it that the Federal Reserve can actually do faster? Is it a rate hike or is it a rate cut? What can the Federal Reserve do at a much rapid pace? Can they raise rates very aggressively, very fast, or can they cut rates very aggressively, very fast? What is it that they can actually do overnight if needed? What is it? You guys tell me in the comments. What can they do much faster, a lot easier, and can be done pretty much overnight if needed? Is it quantitative easing or tightening? Is it rate cuts or rate hikes? So none says easing first and then rate hike. Eric says raise. Interesting. You guys think that the Federal Reserve can raise rates much faster than they can cut rates? Wow, we got a couple people talking about raising rates. So Joseph says cut. Come on, I want more participation, more engagement, because if we're going to learn together, if we're going to try to think about the different psychologies of the market and the Federal Reserve, we really need to kind of engage more. I want you guys to answer. You know, it doesn't matter. Take a guess, because it's going to get you involved. It's going to have you thinking. It's going to get more people, asking questions and engaged as well. So just comment, right? Whatever it is your guess is. Okay, so we've got a lot of cuts coming in. So yes, it's correct, right? So rate cuts is much faster. It's much easier to do than to raise rates. Raise rates, it takes years, right? Because the economy cannot handle such a shock of raising interest rates to too much, too high, too quickly. That's why if you come over to the federal funds rate, you'll notice that rate cuts almost happen instantaneously, right? If there's any signs of economic weakness, if there's any signs of recession, if there's any signs of economic contraction or unemployment going higher, the Federal Reserve can, with the flip, can just literally just cut rates down to near 0%. And they've done it multiple times. And they've done it, during the dot-com bubble. They've done it during the great recession of 07-08. You just take a look, just a couple meetings, and we've gone from 5% down to 0%, right? Just a few meetings. Over here, you can see during the pandemic, just literally dropped from 1.6% down to as much as 0%. And so it takes little to no effort to cut rates. And when it comes to raising interest rates, it takes years, right? Years to raise interest rates 25 or maybe 50. But it's a process that takes a lot of meetings, a lot of years, a lot of decision making, a lot of thinking. So that's why I constantly mention on the channel that the risk of cutting too early far exceeds the risk of cutting too late. Because if they were to cut too late, they can always cut faster and then try to control the economy. But if they cut too early, that means inflation is going to accelerate back higher. That's the risk of cutting too early, is that they are, once again, providing quantitative easing. There's going to be cheap capital in the markets where consumers, businesses, investors, they can all borrow money and then start spending. That money is going to make its way over to the economy, and then inflation is going to be at the risk of increasing once again. And well, guess what? The Federal Reserve will then have to, once again, backpedal on those rate cuts and then move back towards quantitative tightening. And that's the last thing that everybody wants, is the Federal Reserve starts thinking about raising interest rates. So if they are going to embark on this rate cutting cycle, they have to do it in a slow and steady fashion and really, really avoid the possibility of any type of inflation accelerating back up. So coming over to, this. And a lot of folks have been asking about, how is this going to affect TLT and TMF? So if you come over to TLT here, and you'll notice how TLT has been doing, it's actually down 0.5%. Yesterday down another 0.5% right now. So We're seeing a little bit of that momentum back higher on the 10-year treasuries, so up over 70 basis points, back up to over 3.6%. And I think that part of the reason why TLT and TMF, in my opinion, once the rate cuts actually do begin, may not have a lot of marginal upside left is because a lot of the work that the Federal Reserve wanted to do with interest rate cuts have already been done by the bond market. So the bond market, of course, has already been front running the Fed, meaning that it's already been selling off in anticipation of those rate cuts. As you'll notice that the federal funds rate's been pretty flat, right, for the last year and a half, or about 12 to 14 months here. And we've got this right here, which is the bond market, right, openly traded in the market. The bond yields, we've got the 10-year and the 2-year treasuries, they've been falling over. And this right here is the switch between the spread going from negative to positive, meaning the long end of the curve, which is the 10-year treasuries, is now yielding more than the short end of the curve, which is 2-year. For the longest time, you'll notice that we were pretty much inverted. So for as long as I can remember, I mean, over 700 days, the red line, as you see, is above the yellow line, which is the 2-year treasury, the shorter end of the curve, is yielding more than the 10-year treasury, which is in yellow. But that switch happened more recently as the spread once again turned positive, the yield curve uninverted, as we like to call it, and we're moving back to a more normalized functioning credit market. This right here is when that switch essentially happened, where the short end of the curve, which is the 2-year, was now yielding more than the 10-year treasuries, and it's kind of stayed up there for well over 2 years, and then finally rotating back lower. So the bond market has been doing a lot of the work for the Federal Reserve already, and as we know, the yields come down, prices go up, and this entire move, in my opinion, has already been in anticipation of these rate cuts to begin with. So TLT pushing up 18%. TMF has also been on this huge run up from lows of $43. So this right here was where it was trading. It's now coming up to that area of supply. It's already up close to 50%. So a lot of the move, in my opinion, is already baked into the Treasury market right now as it continues to anticipate those Federal Reserve rate cuts. Okay, so downtrend only. If the rate cuts happen, what happens to the market? We'll take a look at that here in just a minute. So Jimmy says the danger is the labor market and unemployment is a lagging indicator. Yes, very true. However, there are some leading indicators for unemployment as well, like the initial claims that we like to follow, and a lot of those are still well below some of the recessionary signals. In other words, the trigger values at well over 400, 500,000. We're still well in the 200s at the moment. But yes, you are right. Unemployment and the manufacturing numbers and labor market, like all those are very lagging indicators, and they can really blindside the economy, especially if you have a consumer that is struggling with the high cost of living and is reliant very much on credit, right? So the debt, overall debt, credit card debt, mortgages, auto loans, everything's been skyrocketing to trillions of dollars, not to mention the higher levels of interest rates that are now starting to come off a little bit. So it really is an economy that, in my opinion, has been strong, or at least given us the perception of being strong on the back of a lot of the usage of debt. It's all in the numbers, right? So we're not making anything up. So it's really just a question of when that debt is going to come due. And if we see those mass layoffs, then of course people are not going to be able to pay back the money that they borrowed, and then the delinquencies begin, unemployment skyrockets further, earnings drop, economic contraction happens, and that's when a recession pretty much begins. So unemployment really has the key to everything. Right now we're kind of in this question or this debate whether rate recession is going to happen or not, because at the end of the day, like 2550 is not that important as the expectations on recession. Because if the Federal Reserve does a 25 basis points or 50 basis points, and in both scenarios we avoid a recession and we have a soft landing, markets are going to be pretty happy. Markets are going to be like, okay, we're getting rate cuts, inflation's coming down, and we're not getting a recession. Time to be very bullish, right? Time to rip to new all-time highs. But if these rate cuts happen a few months down the road, we get into a recession, we see economic contraction, and the Federal Reserve really just slams down rates further, close to 0%, may not be 0%, maybe down to 1.5%, close to 2%. Then the economic contraction begins, and earnings get affected, and we could get in an environment where the markets do see a correction or even a bear market once again. So it's really just the recession has the answers to all of our questions, and recession, if you go a step further, or in other words, go a step back, recession really is a result of unemployment, right? So if unemployment starts to accelerate, that's what's going to cause a recession, which is what's going to cause markets direction. So unemployment really is the key, in my opinion, to most of the questions that we have here. Okay, good morning, everyone. Thank you so much for joining. So we got lots of people tuned in already. So we got a little bit over 340 people. Make sure that you do participate on the poll. I would really appreciate that. Let's take a look at some of the comments here. What are your thoughts on how Palantir and SoFi will react to 25 and 50? I think the rate cuts have a bigger impact on SoFi than it does on Palantir. Being a fintech company, I think it's going to be bullish for companies like SoFi, because of the big student loan, refinancer. 50 basis point cut could accelerate some refinancing activity back, and again drive that loan volume for SoFi, which is very, very important. And then we also know that there's been a big shift in the overall loan book for SoFi over the years. I mean, they were one of the biggest student loan lenders, as well as mortgages, and those are, in my opinion, more secure than personal loans. And that's really where most of that volume has come from over the last couple of years, is they've kind of shifted away from home loans and student loans over to more personal loans. But I think that is going to start changing once again once interest rates start to come back down. For Palantir, though, I think it's more a question of what valuation everyone's comfortable paying. It really has come down to a multiple question. That's pretty much about it, because we do know and understand the growth rates that Palantir has to offer for the long term. And I recently did a video on what it's going to take for Palantir to get to that $1 trillion potential market cap, what kind of numbers it needs to hit on how many years. So we have a very good understanding on, okay, what growth rates Palantir needs to achieve. But it really comes down to a multiple game, because multiples have contracted, but they're still, on a relative scale, very high. I mean, 30 times sales, 90 times earnings. If you're comfortable paying for a stock 90 times earnings or buying it at 30 times sales, that's totally fine. That's your decision to make. But you also have to be understanding that multiples can compress as numbers get bigger and bigger. And as a result of that compression, price is one of the ways that multiples compress, by coming down if earnings are not going fast enough. So that is a decision that needs to be made investor by investor. Louis says, appreciate your hard work. Thank you so much. I appreciate that. So Ruben says, you just have to use your eyes and see all the young people are living with their parents until 30 or co-housing since they cannot afford housing. Yes, housing's been very, very expensive. And I was actually looking at a few different charts reported by Bloomberg the other day, which was showing people in their 30s in the US, how many or what percentage of the population in their 30s owns a home, or I think it was something like has a job, and also a few different variables. Has a family or something like that, and it was all like down. It was down significantly from like the 1980s. It was down from like 60% or 50% was down to like 20 and 30%. So those were, again, very alarming statistics, and a lot of the things that you don't necessarily see unless you're on the ground, right? So on the media, I mean, they'll show you what they want you to know, but other than that, if you're not on the ground, if you're not going to these places and you're not understanding the real world problems by going to a lot of these neighborhoods, you're just going to be very disconnected from what's actually going on in reality. And I totally agree. I think housing's been very unaffordable for many years, especially in the U.S. and more specifically, many pockets within the U.S. It's been extremely expensive. And just me personally, I've witnessed a lot of increases in housing, even though I've not traveled a lot in the U.S. I mean, I've gone there like 3 times in the last like 4 years before I was actually living there. But every year I've experienced at the same locations, higher prices. Every single year that I've been there, whether it was for a week or a month, it's been higher prices on a daily basis. So definitely, agree with you there that it's been very unaffordable. There are a lot more layoffs happening than what the unemployment data is showing. Yep. So that is also a big thing, that unemployment may not be accurately reported, but it's all we got, right? This is all we have for the time being, unless, of course, we go company by company, person by person to kind of start surveying whether you have a job or not. We can't really figure out, okay, what's the actual true unemployment rate in the U.S. or rather in any country, because there's always going to be some inaccuracies in the reported figures that we get. But yeah, I mean, it all comes down to NBER. That's the National Bureau of Economic Research. They're the ones at the end of the day that are going to officially call for a recession if they see one. And it's kind of funny that last year, or I think it was 2022, we did see unemployment stay stable, but economic growth, in other words, GDP did contract 2 consecutive quarters in a row. And by definition, that should be a recession. But NBER never really called it because unemployment was low. Unemployment was still stable and didn't really accelerate to higher levels. So if now we see a combination of unemployment going higher and the GDP coming down, then NBER will have no choice but to call for a recession. So hope you all are ready. Folks, do me a favor, drop a like on this live stream, subscribe to the channel if you haven't already. We're trying to hit over 84,000 subscribers. So definitely do subscribe. I would really appreciate that. If you haven't already, you can get a lot of fundamental analysis, technical analysis, macro analysis, options trading, swing trading, long-term investing. We got something for everyone. And we did a recent survey for our MoneyVest members, and we got some very interesting data points, which I'm happy to share in our Discord as well. We kind of understood better risk profiles and time horizons and just how active people are in our community. And most people said that they are active to extremely active, spending upwards of 10 to 20 hours per week in research and analysis. And the average experience for a MoneyVest member was well over 7 years. So that was actually very, very good to see that we've got some very educated, intelligent people that have been around for a very long time investing in the markets. And it's not just the last few years of bull market that we've experienced, but rather people that have been around for 7 to as many as 10 years and have been doing it for a long time with some very good active involvement in understanding how markets work. So definitely do subscribe, join if you want to, and I'm sure you'll find a lot of value and learn a lot along the way and also have fun, because what good is making money if you can't even have fun? So that's the whole point. Our focus is always going to be on good health, good companionship, good relationships, and then money comes second or third on that list. Okay, we're getting just about ready for markets open here. NVIDIA, I've got some calls and some puts expiring on Friday. I've been keeping track of where we are with the premiums and the returns and everything. I've been updating everybody on the options portfolio every single week. So we'll see what happens with NVIDIA on the day today after Jerome Powell comes out with this speech and the SEP. We'll spend some time on the summary of economic projections because I want this to be a little bit more engaging, and we're going to discuss how the markets may react to different revisions, upwards or downwards, in the summary of economic projections, because whatever numbers we get here is also going to be a very, very important result for the market, because federal funds rate, that's really the number that the Federal Reserve controls. That's why it's the most important number. Everything else I don't really care about. It kind of only helps us understand how the Federal Reserve may be thinking about interest rates. But why? Who can answer here? Why is it that of all the variables that the Federal Reserve reports on the summary of economic projections, it's really just the federal funds rate that matters the most? I kind of gave away the answer there, but I still want to know who can answer that question. That why is it that of all the variables, the GDP, unemployment, inflation, and the Fed funds rate, why is it that the Fed funds rate is the only one that really truly matters from a market standpoint, and none of the other ones really matter anything? Like, it doesn't really matter what the Federal Reserve puts down for their forecast here. It's really just the federal funds rate that holds a lot of the true value in the summary of economic projections. So let me see what answers we can come up with here on the chat. So let me know what you think, why that might be, and we're gonna get ready here. Got almost 500 people watching, so Lokesh says federal funds rate accounts for all of them. So that's a good point. That's a very good point, that it already kind of accounts for the expectations from the federal funds, from the Fed on what they expect the GDP or the inflation or unemployment to be. And it kind of accounts for all of that. But it's a much bigger reason. It's a much bigger reason why the market really truly cares about the federal funds rate as opposed to anything else. Come on, folks. It's a big day. It's a big day. I mean, you're about to witness a historical moment in the market, because this is probably going to be the most important meeting for the year 2024, and might even be for the next couple of years, because we don't see rate cuts very often. This is the first rate cut that we're going to witness in over 5 years. 5 years. I put that on my Instagram as well, that it's going to be a pretty big day, because the Fed pivot. You don't see that every day. And that's exactly why I want to get us pumped up, excited about what is going to take place here in under 5 hours. So share this live stream, get more people on board, because we are ready for Jay Powell. And if he can get 84,000 subscribers in the next few hours, I will be live all the way through to FOMC. So we got 95 more people. If they subscribe, I'm going to be live for 7 straight hours. So let's see if we can actually do that. If you guys want me to be live for 7 straight hours, cover market open all the way from market close, we need to hit 84,000 subscribers. So if that can happen, 95 more people, if they can do it, then I'm going to be live for 9 straight hours. Maybe you'll see me watch, maybe you'll see me have dinner as well. We never know. So, okay, federal funds rate accounts for all the above. First rate cut in market entry. It directly affects the bond market. Prices go up, bonds, opposite risk market stock here. So, I want more answers. I want more answers to my question that I asked you guys earlier. Why does the market truly really only care about the federal funds rate as opposed to everything else? Why is it that the market doesn't really put a lot of weight into what the GDP expectations are, unemployment expectations are, inflation is, all those things? It really is the federal funds rate. Why? What's the main reason as to why the markets may not really care much about all the other variables except for the federal funds rate? I want to hear from everybody in the chat. Why do you think that might be the case? Markets are open now. QQQs are essentially flat, so the calm before the storm has begun. Milan says it's benchmark. Okay, let's see. I want to hear more answers so that we can have a discussion. And I'll go over some of the questions here in just a minute here. Vault, yes, I'll take a look at your question shortly. So just give me 1 second. So the reason why the Federal Reserve and why the markets really care more about the federal funds rate is because that's the variable that they fully control. Okay? Other variables they have no control over, and it's really just a projection at the end of the day, right? So they could be right or wrong. God knows what's going to happen. Nobody has been right about the economy consistently anyway. So it's really a metric that we look at to better understand the reason as to why they arrived at the federal funds rate. But the federal funds rate really is the metric or the variable that they control. Yes, so rate cut is the only one they can control, right? They're the ones that actually are the government agency that stabilizes where rates are going to be. So that's why the markets have a very, very important metric at federal funds rate as opposed to anything else. So yes, a couple of people got it right. Okay, I'm going to go over to some questions here. Aaron says, I've been searching for a job for 8 months. Many of the jobs I'm applying to are in the chemical, oil sector, and mid-management levels. HR is telling me that they are seeing record applicants. So, Aaron, I think in an economy like right now, I think it's really just going to come down to networking and knowing people. And that's why, like I said, our community is also pretty solid. I mean, if you want to join and if you want to ask around, I'm sure we have people in your specific area, industry, and that's what it can be, right? It can be about helping each other, not just from a market perspective, but also from a perspective of, helping somebody get a job if they've been struggling for over 8 months. 8 months is a crazy time, to not be able to find a job or get an interview, or be able to move up the different stages of an interview. So, let us know if you can help, and that's what we're here for. Let's see. Vault says, I hear left and right about 25-50 dovish hawkish cut, but what's your take? Do you actually understand all those arguments from a different perspective of these cuts? What's your take? So yes, when it comes to understanding whether 25 can be both dovish hawkish and 50 can be dovish hawkish as well, I think it really comes down to what kind of tone the Federal Reserve is giving us and why are we getting the cuts, right? What's the main reason? And that's why these variables are going to be very, very important, because then once they get revised up or down, we're going to get more insight into, okay, why did the Federal Reserve cut interest rates? And more importantly, what is going to be their expectation moving forward? So right now, as you can already see, there is a big discrepancy, okay? Now, who can tell me right now, based on these summary of economic projections that we have, 5.1, and the market's expectation for where we're going to be by the end of this year at 4.25%. How many rate cuts is the market pricing in over the Federal Reserve? Again, I'm going to ask you guys a question again, and I really want everyone to take note of this, and I really want everyone to participate and answer. How many rate cuts more is the market pricing in right now over the Federal Reserve? Over the Federal Reserve, how many rate cuts is the market pricing in over the Federal Reserve? Because we know there's a discrepancy. We know there's a discrepancy, right? But how many rate cuts more is the market pricing in? Let me know what you guys think. This year, yes, this year, 2024, this year only, 2024. Okay, so you got Brian 5, you got Further Flunky 5. Further Flunky says 4, Milan says 4, Lokesh says 4, Nikki says 3, Rafi says 3, 2, 3, 4. Okay, so the correct answer is 4. I know a couple of people said 5 because 5 is what the market's pricing in, and 1 is what the Federal Reserve's told us. So my question was, how many more is the market pricing in? So the correct answer is 4, because the market right now is priced in for 5 total cuts in 2024, while the Federal Reserve has only told us 1. So the discrepancy is 1 rate cut from the Fed, 5 from the market, and that's 4 additional that the markets are pricing in. So once we get these summary of economic projections, then the question is going to be, the question was weird? No, it wasn't. How is that a weird question? I asked you guys how many rate cuts is the market pricing in more than the Federal Reserve? It's just a simple question. Market's pricing in 5, the Federal Reserve is 1, and so that's 4 additional cuts. I don't understand why that was so tricky. But anyway, so as this number gets revised up or down, it can be, interpreted by the market in a lot of different ways. If the numbers come down from 5.1 to 5%, sub 5%, that's, in an ideal world, it could be bullish because the Federal Reserve is now opening the door for more rate cuts, but at the same time, it's not as many as what the market's pricing in. So it could be, the markets could have a mixed reaction to those type of numbers. If the market gets a number which matches those expectations, I think that can be very bullish because it's only going to reaffirm what the market's already been expecting, right? So market's pricing in for 5, and the Federal Reserve comes down, gives us 5, right? So the 4.6 is pretty much going to be 2 rate cuts. We'll need to come down. We'll need to see this number down to 4%. 4% in order for it to match the market, because the market is at 4% also, 4.25%. So that number would need to come down to, like I said, 4% in order just to match what the markets are expecting. But if it's anything above that, then you make the judgment call whether that's going to be bullish or bearish for the market. In my opinion, I think the market may not buy it as much because even in the past, the Federal Reserve has been, pretty strict. In June, we got that revision upwards to 5.1%, and now we're expecting the rates to get cut. So markets may not kind of take the Fed seriously from that perspective. So either way, I think the markets are really going to not take the Federal Reserve seriously unless they don't cut by 50, unless if they do by 25. Then the markets are going to be in a little bit of a cycle here where, okay, the Federal Reserve is not playing around. They're not going to give us what we are pricing in because that would be a huge surprise. It really is like a game of chess right now between the markets and the Fed based on all of these expectations, because there's so many different probabilities of what could happen at 2 p.m. from both a statement standpoint, from a summary of economic projection standpoint, and from the speech standpoint, because we've kind of opened up that gap so much, right? 5 cuts is a lot. If it was like 1 or 2 additional cuts, it would make sense, right? The Fed can match that. But right now, it's just the gap is like too wide. 5 cuts is a lot. And if the Federal Reserve doesn't match the market, it could get disappointed. If it overshoots the market, then that would also be in my argument, it could also be bad, because then the markets would be like, okay, why we were pricing in 5, why is the Fed telling us 7? What do they know? Is it a recession coming, right? You know what I mean? So it really is going to be quite an interesting overall psychological game between the markets and the Fed here. Yes, so 90% of the times, last 2 weeks tend to not be great. I've got a couple of charts for that as well. So if you come over to, let's see, over here, the screenshots, we've got, the last few trading days have not been good for September. So we'll see, what that looks like for the market. But so far, September has been flat for the market. We're down about 23 basis points after hitting a new all-time high yesterday. And NASDAQ is down about 0.5% after really consolidating sideways for the most part. So folks, if you want me to go over macros, fundamentals, technicals for the entirety of this market open, we need to hit 84,000 subscribers. So, wow, that's crazy. Like, you guys really want me to be around for 7 hours? If you get to 84,000, we are going to be live for 7 straight hours. Wait while Jerome Powell gets ready for those super cuts that are coming in under 5 hours. So subscribe to the channel if you haven't already. I would really appreciate that. And we're going to be here for a while. God, 7 hours is going to be a long time. I've never done this before. But, I mean, it's almost 10 a.m. So 11, 12, 1, 2. See, I got a bottle of water because I do have faith in you guys that you guys are going to keep me here for a long time. So, but markets are very, very flat right now. So it's really just a flat open at the moment. So what sector is the safest to invest before 2 p.m.? I mean, it's a very, very short-term tactical question. And, even if we knew exactly what the Federal Reserve is going to do, we may not be able to fully understand how the markets may react. And that's what's interesting about the markets, right? Even if you could have tomorrow's newspaper in your hands right now, you may still not make the best decision. Why? Because you can never know how the markets may look at that piece of news and how the reaction may be. So that's what makes the market so interesting, is that you can have the info and still not make the good decision because of so many variables at play. But speaking of, if you actually go over to the charts over here, this is actually very cool and very interesting data from stock charts. And what this shows us is the different sectors. This is a relative rotation graph. And what this shows us is which sectors are leading versus which sectors are weakening, lagging, or improving. And I'm going over to weekly time frame here, and we're going back 4 weeks. And you can increase the tail length on this a little bit more. So if you go to 8 weeks, you can see the performance of 8 weeks and how different sectors have done. We've talked about this, in terms of different sectors on our channel. Before, the utilities has been a big leader this year in 2024. Real estate has been a big leader in 2024. In fact, we talked about how everything is really just seeing a lot of momentum to the upside. So, if you come over to our, market snapshot here, you've got financials, utilities, staples, materials, consumer staples. A lot of these are well within 1% of their all-time highs, right? Well within 0.5%, I should say, from their all-time highs, versus something like technology, still struggling, energy, still struggling. And that's what this chart does a really good job in showing us, that real estate, staples, then we've got utilities and financials. They're the ones that are actually leading this market higher. And then you can see how technology went from a leading sector over to a lagging sector. That's the red one you can see. And then energy also has been kind of spending a lot of time under lagging because oil prices have been coming down. And then we got discretionary, materials, and industrials. They're kind of improving a little bit. They went from lagging. So if you go back a little bit, you'll notice that they actually went from lagging over to improving now. So if they kind of fall in the top right quadrant, they're going to start leading the markets once again. So it shows us really well on what sectors are performing versus which ones aren't. And utilities, it's really been it's been a game of being defensive so far in the market. In 2024, technology, as we know, has lagged significantly compared to utilities or staples or defensives, and it's really just been technology that's been struggling, and utilities have been leading the markets all the way throughout 2024. Okay. So let's see. Luminous Warrior. If he knows all the analysis, why is he making videos to increase subscribers? So what specifically is the question? Are you asking me or are you asking someone else here in the chat? What time we will know? So 2 p.m. Eastern. 2 p.m. is when the numbers come out. And 2:30 p.m. is the press conference. So 2 p.m. we get the statement and the summary of economic projections. So you can pretty much take a look at this on your own on the Federal Reserve website. If you come over to the monetary policy, meeting and calendars, and over here we're going to reload this page right at 2 p.m. Eastern, and we're going to get the statement as well as the projection materials, so the PDF here. And just to kind of show you very quickly where we're going to be looking at immediately, because it's going to be very quick, right? Right at 2 p.m., we're going to open the statement. We're going to open the projection materials. I'm going to show you exactly where to look and then quickly come back to the markets to see how the markets are reacting. So when we open the statement, the second paragraph, or really just the third paragraph, is what we're going to be looking at in support of these goals. The committee, whatever that says, decided to, most likely is going to be reduce the target range of the federal funds rate. And right now you can see it's 5.25% and 5.5%. So if this number comes down to 5 and 5.25%, that means it's a 25 basis point cut. So if you're looking at 5 to 5.25, that means it's a 25 basis points. Or if this number comes down to 4.75% and 5%, then it's a 50 basis point cut. So I think it's really important for everyone to remember that. So again, that's the first thing we're going to be looking at 2 p.m. Eastern, and that is the interest rate cut itself. So once again, 5. If this number is going to be at 5 and 5.25%, that means we got a 25 basis point cut. Or if it's a 4.75% and 5%, that's a 50 basis point cut. Then we're going to move over to the projection materials, and we'll take a look at what forecasting the Federal Reserve is doing, and then come back to the market to see how much we're down or up. You don't know, but it is going to be a very, very volatile event. And that's why I've kind of encouraged everyone to share this live stream with as many people as possible, because the market has never been so uncertain about the Federal Reserve interest rate decision in the last 15 years. And if the Fed cuts by 25 basis points, it would mark the largest surprise seen since 2008. So 25 would be a very big surprise. And on the other hand, if the Fed Central Bank cuts by 50, it's going to be a larger surprise since 2009. And this right here is just the significant uncertainty that we are about to witness in the market. A few of you guys talking about volatility. So we are up. So we're 18.5 right now, up over 5% as the VIX is increasing. And you can also take a look at the forward front two futures, volatility futures. If we come over, oh God, just give me 1 second. We can also come over to VIX Central to better understand what that volatility futures are telling us for the next few months. Ooh, what the heck? We actually just went into backwardation. We were in, wait a second. I just want to take a look at historical prices. Where were we yesterday? Because that is crazy. Backwardation means the markets are now pricing in for the front contract, which is the M1, the next month basically, is going to be higher than the next month, right? Essentially, M1 is going to be higher than M2, and that's when we go into backwardation. And we just went into backwardation here. Folks, this actually might be a red alert situation because we were 6.72% in contango. M1 was priced at around 17.8 and M2 was priced at 19. But right now as it stands, if you go over to today's date, we just went into backwardation. Actually, you know what? Never mind. Just give me 1 second. Never mind. I freaked out. I didn't look at the date. It's Wednesday, the third Wednesday of the month of September. So that contract was supposed to expire today, and that's why we just went into, we just basically converged with the M0 value, and that's why now this is M1, and this is M2. But hold on 1 second. Let me just refresh. And we're still, right now it's showing up as M1 priced higher at 19 versus M2 at 18.7. So negative 1.73% of that value. Volatility is 18.7, so almost at 19 right now. Volatility is expected to be higher going into this event. We've got QQQs very, very flat right now, just trying to find that direction. And S&P 500 also very, very flat going into this event. JT, are you live non-stop? Well, you guys are going to decide that. You guys are going to decide if I'm going to be live. If we get another 80 subscribers in the next 15 to 20 minutes, I will be live for the entirety of this market open. And also stay live for the Federal Reserve meeting and for Jay Powell's speech and statement and everything that's going to be coming out. And if you don't hit that target, that's okay. I'll be live in a few hours to also go over the Jerome Powell. But if you guys want me live for the entire event, 7 hours, it's going to be a lot of hours, subscribe. We'll see if we can actually hit that goal. And how badly do you guys want me here? Take breaks every 15 minutes for 15 minutes. Yeah, but what am I going to do on that break? So really, the whole plan for today is to be live as much as possible. And I only really need to take like 15, 20 minutes to talk to my family and also have dinner for 15, 20 minutes. So it's like 30 minutes for the next 6 hours that I need for myself. But otherwise, I can be live. Only if we hit that goal, though. Only if we hit that goal. So, ooh, look at that. A huge jump in the put-call ratio. We just got up to over 4.3, folks. 4.3. That's the highest level that we've seen since August 5th. A lot of hedges for today that are placed right now. 66% increase. Again, there's a lot of things that are happening right now in the market that we should really be talking about, like the put-call ratio, 1.3. The volatility central going into backwardation, minus 1.78%. So I think that's one of the reasons why, or really that's the reason why it's gone into backwardation, is because of the put-call ratio jumping to over 1.3. Now there's more put options open on the market than there are call options. And that imbalance is creating an implied volatility that is expected to be higher, thereby creating the M1 contract, which is priced higher compared to the M2 contract, thereby putting us in backwardation. So hope that makes sense, because, on a surface level, it may seem like, oh, this is crazy. It means a lot. But if you really just understand the reason as to why this is happening, is because put premiums, when the markets are near all-time highs, put premiums are generally cheaper than if they were trading down 20%. So institutions, hedge funds, even retail, large money managers, whales, what do they want to do going into this event? Protect. Many investors, what did they do to protect? Move out of technology, move out of discretionary, move out of risk over to the sidelines. Money market funds, utilities, staples, right? That's where they're going to hide out on the sidelines until this uncertainty passes. And that's when they rotate back into risk. Some other investors who do not want to sell, who do not want to take on that tax burden, may buy puts, right? And that's what this represents. Buying puts, selling calls, some of those hedges, putting them on. What the? 1.6. It just crossed over 1.6. Live. we literally just triggered above the same value that we've seen October 23. Everyone saw that, right? Hopefully you guys are not just listening but also seeing the live stream. 102% increase, 1.6. Just crossed above that level. So there's definitely a lot of imbalance. There's a lot of put options open right now going into this meeting. I mean, this is wild. I mean, this is actually crazy. And volatility is climbing up to almost 19 right now. That's pretty much what the M1 futures contract is pricing in right now. And wow. That was a quite an incredible spike here in the VIX that we just witnessed together. It kind of feels like Easter eggs. You know, when you see those in real time, there are some things that if you see in real time just hit you very differently versus if you would kind of come back to it. And now I've seen put call ratio spiking to over 1.6, a trigger value which we have pretty much pointed out. First time ever. We've also seen volatility at 65. So that I think is the pandemic is the record volatility that we've seen in the VIX, right? So of course we were at much higher levels at over 85. So 85 is the number to beat for volatility in my lifetime. If it ever gets up to over 90, 95, 100, I will remember that day. Just like I remember 85 for the VIX. I remember 65 for August 5th this year. And now I remember put call ratio to 1.6. The last time it triggered that value was back in October 23. Didn't catch it live though. Didn't see it live. So yeah, that's where we are. And then if we take a look at, SPY short sale, you can also take a look at this. This is FINRA reported value. And if you come over to the daily, you'll notice that we have been seeing a slight increase since last Friday. So Friday, Monday, Tuesday, this number is not updated yet because it takes time. It gets updated end of day. And, we're still pretty elevated for this number. However, coming down from those peaks from back in December of 2023. So short sales are still pretty heavy on SPY. Then I was also looking at NVIDIA short sales the other day. So, you'll notice how much it's come down, how shorts have been covering on NVIDIA. And this really what justified the rally that we witnessed last Friday or last Wednesday, September 11th. We saw NVIDIA just ripping higher on the back of that press conference from Jensen Huang at the Goldman Sachs conference. And then, of course, pushing up over, I think, 9% intraday. In my opinion, that happened a lot on the back of short covering because the volumes were really low. The volumes have been really, really low in the market. And, if you come over to the CME, God, I don't know why this keeps happening, but if you come over to CME liquidity tool, you'll notice that we actually are witnessing the market breadth, which is lower than what we are used to seeing. So let's just come back here. So if you come over to the S&P 500 futures and we're looking at the book depth, and if you hit the view chart, it's been broadening out a little bit, but just take a look at how narrow we had gotten down to for that book depth, right? So if you compare this to, let's say, where we were back in 2022, so 2 years worth of charts, as we have discussed on the channel before, you'll notice how we were really, really wide on that book depth. And the markets, of course, are pushing higher there in blue. We've seen instances where it gets really, really narrow. That's a move that's happening on a very weaker breadth, and the rally may not have legs to stand on, and then eventually starts to fall apart. And this right here was the momentum that we witnessed, and it's really just been in a lot of back and forth here, as the book depth has been cut in half, right? So it peaked out in July, hit a new all-time high yesterday very briefly, but it's not happening on the back of a lot of breadth here. If I show you the bid-ask spread over here, and again we're going back to 2022, you'll notice that we also witnessed another spike here. Let me just go over to more recent data, and you'll be able to see it better, because we do see these upshots on the spreads, and that simply means that there's liquidity gaps. If there's lack of liquidity, spreads are going to be wider between the bid and the ask, right? So if it's a very, very tightly traded market, if there's a lot of liquidity, there's buyers and sellers everywhere, you're going to see spreads that are like very, very tight, very small in terms of those ticks. But every so often you'll see this kind of blow up a little bit, just suggesting that, okay, there's lack of liquidity, right? Sometimes it happens on the market bottoms. Sometimes it happens on the very tops here as the markets rolls over. But it's still an important indicator to understand that there's lack of liquidity. Whether it's on the upside or the downside, there is lack of both buyers and sellers. That's why there is wider spreads in the market. So that's where we are. Put call ratio is still above 1.5 right now. QQQs are flat. We're just going to be anticipating what the data is going to be coming out. And S&P 500 is also very flat. Tesla is up 34 basis points. We've got Nvidia basically flat. Apple is the only one that's kind of leading on the day right now. Let's come over to our market concentration. Markets are flat, only up $44 billion. Big three are up over $33 billion. Max 7, $44 billion. However, a lot of that is coming from Apple. Apple is the big winner. $42 billion right now as of this moment. Google up $13 billion. Broadcom is leading. Nvidia is up over $10 billion. Tesla, $2.3 billion. Applied Materials, and the ones that are down, Microsoft, almost $20 billion. Oracle, $5.8 billion. And we really, built this market concentration for you to better understand where the liquidity is going to and where is it coming off of. You can select different industries. So if you select semiconductors, collectively they're up over $30 billion right now. If I select for utilities, which has been one of the leaders in the market, 31 stocks in the S&P 500, collectively up over $446 million. And then if you look at banks or financial services, which includes, your PayPals and Visa and MasterCard and American Express, and then of course you include for banks, JP Morgan and Citigroup and Wells Fargo, Bank of America, down over $12.4 billion collectively. Just over 11% weight in the S&P 500. So a little bit over 5.7 trillion. So we've built this to better understand where liquidity goes and where is it coming off of. And yeah, that's where we are. Everyone, we are up to 836 votes. So make sure that you do participate in the poll on the Federal Reserve rate decision. 25 or 50 or unchanged or 75 basis points. Right now we've got an overwhelming majority on 25 basis point rate cut. Almost 60% of people are expecting a 25 basis point rate cut, which is going to most certainly surprise the market because the markets are very much priced in for a 50 basis point rate cut. So according to the tool over here, 59% probability. Man, if this number goes back to 50-50 in now under 4 hours, we've got the Fed meeting. If this number goes down to 50-50, that would be the most uncertain the markets have been about a huge decision towards the very last minute. It would be wild. I mean, this is truly something that if you experience live, it's going to be crazy. Because it's a pretty big decision from the Fed, and yet the markets have no clue. No clue. So I can only imagine how the markets are going to react after the numbers come out, and then of course Jerome Powell starts talking. So it's going to be a lot of swing and emotions for the markets and for ourselves as well. Let's see where we are on the subscriber count. We are at 27, so we still have a lot of work to do. I'll give it a few more attempts, few more minutes. If we can get to 84,000, folks, I'll be live for the entirety of this conference, and I would really appreciate that. Drop a like, subscribe to the channel if you haven't already. I mean, we can easily get to that number, I feel. Not all 600 of you guys watching are subscribed, I'm pretty sure of that. So make sure that you subscribe if you're enjoying the live stream, if you find it helpful. Would really appreciate that. And if there's any other questions that you have, I'm happy to go over that as well. So we can do a little bit of a Q&A with everyone right now. May not play around with the charts as much, but I can share my opinions analysis on that. Okay, let's take a look. Hugo, how long did it take for the market to flip after the Fed cut rates before the last recession? Was it a couple of months? Okay, so markets to flip after the Federal Reserve cut rates. So the last recession was 2019 or 2020, I should say. It was a very, very short-lived recession. The Federal Reserve cut interest rates in July of 2019. So it's been well over 5 years since they cut the last time, but it was a 25 basis point cut. So we cut in July of 2019 by 25 basis point. They kept rates there for another few months. And then February of 2020 is when we got the news about the pandemic and the economy shutting down. And, the markets pretty much started coming down. It's pretty much started crashing. And that's when the Federal Reserve cut interest rates down to 0%. And it was a very, very short-lived 2 months, basically, is what the markets crashed and then quickly reversed back higher. Maybe you go live every day for 1 to 2 hours. You can increase subscribers. Yes. So we do have most of the days we go live for about an hour, but then also not every day. But maybe I can do every day. I can think about that. I do wanna spend time like trading as well, sending alerts in our Discord, and becomes a little bit more of a challenge if I'm managing the live stream, the live chat, and then looking at the options chain and the portfolio, and then sending out alerts in Discord and everything. So it becomes a bit of a challenge to kind of multitask every day. So I prefer to do live streams on these important days, and then other days just really focus on trading, and then looking at different stocks and options and all that stuff, and sending out alerts. Subscribe to from my 2 other YouTube Gmail accounts. Thank you. I appreciate that, folks. I really do. Let's see. Anyone long Palantir? I think a lot of people are long Palantir. Palantir has been performing incredibly well over the last couple of years, and really the switch happened after the company went profitable. We've talked about it on the channel before, and we've talked about it on our website. So if you come over to Palantir here, you can start to visualize what those numbers look like. So fundamental analysis, quarterly numbers, go back 12 quarters, and all you really have to plot for the net income, and you'll see where the shift happened. This is 2022 December quarter, and then you can see how the company from a loss-making company to a GAAP profitable company, and then we just have never turned the corner ever since. Like everything else is history. Every single quarter, year over year, quarter over quarter, very nice growth for Palantir, and 932, not bad. So that's been the overall shift in Palantir's business, and that's pretty much what marked bottom, at 593, and then over 500% gain from those levels. So technical analysis on CSPX, we non-US residents buy due to tax treaties. I'll take a look at that in just a minute here. John says 50 basis points shows weakness. 25 would just make a correction. They do 50 or 75, that is weakness, John says. I agree. I think anything more than 25 may signal something that the market may read into, not in the best way. Now, on a short-term basis, it's still going to be good because it's quantitative easing. It's a huge pivot. Lower the rates, more spending, more borrowing, more quantitative easing in the markets and the economy. So on a short-term basis, it's going to be good news. And that's exactly what happened back in 2007 and 2001, where the Federal Reserve cut 50. Both times, the markets actually had a very positive reaction in the short term. But then we know what happened after, in months and years after the Federal Reserve 50 basis point rate cut. We just were absolutely crushed. But there were also different systemic problems in the economy back then. So I'm not saying that this year is going to be similar to that, but I think it's important to understand what that 50 or 25, what does that represent? Is that if that 50 is coming off of a level of confidence that we feel like there's been a lot of restrictive policy and inflation's been trending lower, we no longer feel the need to be at such a high restrictive level, and we're still seeing very strong economic indicators, labor market is strong, everything is good. Like, again, it depends on the messaging from the Fed. Then I think it'll be very well received, because then the soft landing scenario will be back on the table. Everyone will be cheering on the soft landing, and again, the Federal Reserve avoiding any type of hard landing or recession. And it would be quite legendary from the Fed. I think Jerome Powell will get his legendary status if he's able to steer the economy away from a recession. But at the same time, Fed is the one who actually put us in there in the first place by talking about the inflation numbers being very transitory. And eventually what happened is that we got way too out of control to get up to over 9%. So you decide if the Federal Reserve did a fantastic job or not. They did a very good job in bringing inflation down, but they're also the one that put us in there in the first place. So John says, I'm more curious about to see the bond yields. Yep. I think everything's going to be moving at 2 p.m. The dollar, volatility, the bond yields, equity markets, gold, Bitcoin. I mean, there's going to be a lot of asset classes. So what we really need is literally just a lot of charts here. So what I'm going to do is I'm going to keep the 4 over here. We'll put S&P 500. We'll put the NASDAQ. We'll put gold. We'll put TLT. Then we'll put volatility, crude oil, the dollar index, if I haven't mentioned it already, and Bitcoin. So we have like 8 or 9 different asset classes that are most likely going to be moving on whatever that news comes out. And some obvious movements, yields come down, prices go up. The dollar index comes down, goes up, depends on how the rate cuts are. And then, of course, that's going to affect the equity market. So the dollar index comes down, markets may move higher. And that's going to be correlated with the volatility as well. So if volatility comes down, markets are going to be moving higher and vice versa. We're about as flat as it gets. This is about as flat as we can be. We are just at 0.00%, like literally nothing. No movement on the markets right now. Okay. Time to start making acts to keep caddy on. Accounts, you mean? Guys, don't do that. Don't make accounts just to subscribe. We really, really do want people who really want to be here, right? Be a part of our community. So definitely do subscribe if you are enjoying the content. I would appreciate that. And what's the impact on the bond yield if you see 50 basis point cut? Again, as I mentioned before, I don't think it's going to be a huge impact on the bond yield because it's already been kind of front running the Fed. We're back down to 1.24 on the put call ratio. So it's certainly been quite an incredible move here on the put call ratio. We went up to as much as 1.59, coming back down to 1.23. So some puts getting closed out on S&P 500. Let's see if we're still in backwardation according to VIX Central here. Yeah, we're now in more backwardation than we were before, down 2%, and that's usually not good for the market. In the past, it has sent us in backwardation. Has been one of the early signs of elevated volatility, and of course, the market's not doing well. So we'll see what ends up happening here. Which scenario is the best shot to ride the wave today? So in which direction you want to ride the wave is it to the downside or is it to the upside? Because this is a meeting where there's a lot of probabilities, as we know. And even if we had all the answers, we'd still not be able to fully figure out how the markets may react. In my opinion, the most bullish, it's kind of funny because any scenario, you can make a case for the markets not reading into it in a positive sense. So, in my opinion, the most bullish scenario, what does that look like? Well, that looks like a 50 basis point cut, exactly what the markets are expecting, although it's going to disappoint 40 to 50% of other people, 41% from the market and 31% according to our poll. But 50 basis point cut, and then expecting another 3 cuts in 2024. I think that, to me, could be bullish, but at the same time, it begs the question, why is the Federal Reserve now moving so fast, right? Do they see a recession? Because look, they're never going to come out and tell you we see a recession and so we're cutting rates. They will never spook the economy. They will never warn the economy like that. They will try to keep a brave face despite of what they're seeing. They will try to come out and say, economy's strong. We're cutting rates because we don't need such a high restrictive monetary policy anymore. And that's it. And so that's what I was thinking about last night. I was like, they would never just come out and say that, okay, we're cutting rates because we see a recession coming, right? That would be the worst thing. So it kind of is up to the market how they view rate cuts. Is 25, in my opinion, 25 is going to be the most obvious beginning of a rate cut, which is not going to spook investors, but at the same time is going to get us started. But 50 is what the market's pricing in. And 50 could, in my opinion, there's a possibility that it sends the wrong message. And if there's more rate cuts, it has both positive and negative implications to what the markets may read into it. Positive meaning that, oh, great, we're getting rate cuts and, we're back to quantitative easing. Negative could be like, why? Why are we getting so many rate cuts? What is the Federal Reserve not telling us? So Non says 50 basis points cut will push the panic button. So I really want to know, from everybody here, how would you read into a 50 basis point cut? If the Federal Reserve comes out and the first cut is 50, it's not 25, it's 50. What is the first thing that goes into your mind? Like, is it because they feel the rates have been way too restrictive for far too long and it's finally time to normalize them? Or would you read into it from a sense of, okay, the Federal Reserve knows something that they're not telling us, the economy is not headed in the right direction? I mean, it's certainly weakening, and that's why they want to get ahead of this recession before it gets worse. Like, what would be your reading of a 50 basis point cut? I really want to know. Is it going to be more positive, or is it going to be a little bit more negative? So like let me know in the chat what everybody would think of a 50 basis point cut. So Ishwar says panic. Alistair says 50 means market is in trouble. Iceman says we are screwed. Short-term bullish. Weak economy, a 50-point cut. There will be a recession. Okay, a lot of people will read into that 50 as a recessionary signal or something that may not be moving in the right direction. So that's why they want to do 50. Spencer says more panic. Inflation is still too high to do a 50 without some type of concern. Ryan, every reaction in the market is initially a knee-jerk overreaction. Wait for the reaction, let it settle, play the other side. That's true. And market takes a approach, and that's partly because of the algos, I would assume, because the algos kind of go through these reports, they read into certain keywords, and then they make those decisions automatically, and then the markets digest that report, and then the actual move begins after a couple minutes of that knee-jerk reaction. So, toothpaste analogy, they see something we don't. You never know. You never know here. And also I was thinking about is that there's always that uncertainty on the way up, but there's never an uncertainty on the way down. Why is that? Can anybody answer this question? Why is there always uncertainty when the Federal Reserve is raising interest rates versus when they're cutting them? There's always going to be that uncertainty. Okay, how high are we going to go when it comes to interest rates? But on the way down, there's no uncertainty, especially when we're in a recession. There's no uncertainty around it. That's also one of the reasons why rate cuts tend to be more bullish than rate hikes are bearish. Okay, none says 50 means danger. Market keeps setting traps. Stocks will drop 10% today, KK says. Fed just said 50 is overblown. 50 is saying 25 basis points. Yeah, Bullard just said 25. So, but the reason why, to the upside, there is more uncertainty is because we don't know how high the Federal Reserve is going to go. But when it comes on the way down, it's a lot easier to predict, or really just be a little bit more uncertain because of the fact that it can't go below 0%. The lowest the Federal Reserve is possibly going to cut down to is 0%. So once they run out of toothpaste, they run out of toothpaste, right? They can't create more. So big event. FOMC just tweeted, Federal Reserve just tweeted on X. Watch live the press conference, Chair Powell, 2:30 p.m. Eastern. Yep, lowest we go down is 0%. Folks, we are at 993 votes, 994. Make sure that you do participate in that poll. And 5 more votes until we get to 1,000. And so from 1,000 votes, 58% of folks expect a 25 basis point cut. 25 basis points. And then 31 are expecting 50. Nvidia is slightly down, back under 115. Let me just take a look at Fed tweeted, I promise we are good. So Netflix down 1.5%, Microsoft down 80 basis points. One of the big losers on the day in terms of market cap. We got AMD, Nvidia, Amazon, Meta, Google, all of them selling off. So let's take a look at my options portfolio right now. So underlying shares are up almost 7%. The Nvidia put that I'd sold earlier in the week up over 31%. And the covered calls are up 43% after the sell-off today. All of them expire this Friday. So everything expires this Friday. I will be closing some of these contracts out, most likely the put, unless Nvidia pulls another Nvidia from last week and it drops like 10% in one day or something. If it trades below 111, we're going to be in a pretty good spot. If it trades below 111 but trades above 107, we're going to be in the best spot. But if it trades below 107 by Friday, we're going to be not so great, because then I'll be assigned on my put. My covered call will still expire out of the money, so that's perfect. And my cost basis will be lowered significantly. I guess that would also be a pretty good spot, because then I'll be able to roll, basically sell more calls for next week. But it all really comes down to today. I think I'm not really worried about tomorrow or Friday. Volatility will die down, but I think it's really just today that we have to survive on Nvidia. And if Nvidia stays above 111 today, then we're going to be a pretty good spot. If it crosses below 111, which it could, it's a huge possibility that it does, what is going to be that drawdown on an intraday basis? Let's see. For Nvidia, down to $111, that's going to put us at a 3.5% red, which is 5 minutes worth of work for Nvidia. If you ask me, it's very easy for Nvidia to be down over 3.5%. So Devidas, why does the market pricing in 5 cuts when the Fed said 1? Did I misunderstand something? So not really. I mean, the markets are free to assume anything they really want, and that's why they're pricing in for as many as 5 rate cuts in 2024. And something that we have discussed on the channel before is the discrepancy between what the market is pricing in versus what the Federal Reserve is telling us. So right now we got 2, 3, and 5 rate cuts priced in for 2024. Federal Reserve's pricing it told us 1, and that number will change. This number will get revised up or down once we get that statement at 2 p.m. 2 p.m. 3 hours left. How are we doing on subscribers right now? So only 2 more from the previous numbers. So make sure that you subscribe, folks. We're trying to get to almost 84,000. We're almost there. I would really appreciate that. We got almost 600 people watching. So definitely do subscribe if you haven't already. We talked a lot about fundamentals, technicals, options, everything on the channel. You can pretty much expect swing trading, long-term investing, except for day trading, and then of course options trading as well. Does your rate cut help Tesla? My rate cut I'm not cutting any rates. Free indeed. The Federal Reserve is. I am not, but Tesla should be helped. Should benefit from that because, and we talked about how auto rates, auto loans, they hit a high level of I think over 8 to 9%, might even be higher. So as those come down, affordability increases, and Tesla tends to do a lot better in a low interest rate environment. It's a discretionary spend at the end of the day, very similar to Apple, than other companies that may not be as interest rate sensitive. So it's most likely going to help that stock as well. But again, these are a lot of long-term catalysts. The rate cuts are a tailwind for most companies than anything else. It's not going to be instantaneously rates come down 50 basis points, Tesla rips like 10% or anything. It could, but I'm just saying that we're going to see the effects of these rate cuts over longer time frames as more and more quarterly numbers get released, because it takes time to plug these rates into the entire economy, and for consumers' behavior to shift to a lower interest rate environment. Right now, everyone's already dealing with higher interest rates for over 1 year, over 2 years, I should say. And everyone's gotten accustomed to where rates have been. Sorry, voice text got it. Okay. I don't think there was anything else on the calendar for today. I think maybe a few more things that we can go over. I'll take a look. And so for today, MBA mortgage applications, mostly housing indicators, Atlanta Fed, business inflation expectations, and that's pretty much it. So mortgage applications came in at 14.2%. That's actually quite a substantial increase compared to the prior number of 1.4%. So week over week, we're seeing a pretty significant increase. And part of that reason is probably because how low the mortgage rates have now come down to, compared to where we were just about a year ago. So if you look at these numbers here, you'll notice a 30-year mortgage down to 6.2, 15-year mortgage down to 5.2. So significant reductions compared to where we were October of 2023. So home affordability slowly and steadily kind of increasing. Purchase index 5.4, and refinance. Should have talked about this earlier, but wow. Take a look at this. Refinance index week over week, 24% increase in applications. That's a lot of refinances. I feel like people could have waited on refinancing. I mean, that's a pretty big jump. Yes, they're probably getting a better rate than, and these might actually be a lot of the buyers that have bought, let's say in the last couple of years, that are seeing this opportunity that, okay, rates are coming down, let's just go ahead and refinance. But I feel like they most certainly could have waited for rates to come down further. I think there's a possibility that 2025, a year from now, the likelihood of us to be in lower rates, mortgage-wise, than where we are now is much higher. So definitely in the game of patience, could have played a bigger role and benefited these people more. But they can always refinance, of course, later as well. But there's costs involved with that as well. Money Invest Index, almost at 4. What's the highest it's been? Not much room to the upside. Yes, so we are at 3.92 right now. Sent out a warning when we were at just over 4 back in August. That was kind of like the video that I said, your September warning is here. Then we dropped to 3.44 in the first week of September. Prior to that, we were at 4.16 back in July. We've kind of flirted with that 4 level multiple times. This was back in March, back in December 23, back in July 23. So every single time, it doesn't take a genius. When we're higher, it eventually comes down to 3, 2.4, 2. And those are some of the levels for us to buy, where the risk reward is really, really good. And then we had housing starts and permits. We had the annual rate 1.356 million. and Atlanta Fed business inflation expectations. It's a survey that provides a monthly measure of year-end inflation expectations and inflation uncertainty from the perspective of firms. So where do businesses and companies see inflation 1 year forward? And that number came out at 2.1%. So that's actually a little bit better than what the prior number was. So Atlanta Fed business inflation expectations at 2.1%. So in other words, businesses and firms see inflation on a 1 year basis, 1 year forward basis, to be at 2.1%, which is very close to the Fed's target. And then other than that, I don't think we have anything else that came out that was of interest. And we are going to be ready for Jay Powell. So we are looking at over almost 1,100 votes. 58%. I'm going to start to get tired here. How long have I been doing this? We've been going on for just over 2 hours now. Just over 2 hours. I don't even know what's been our longest live stream. Does anybody know? I think it might have been like 3 hours. Maybe a couple of years ago, or back when I was younger, when I didn't nap much. Anyway, so if you have any questions, let me know. I don't think we've hit that target yet for keeping me live. So we're at 83,938. We're about 60 people away, 62 people away from getting up to 84,000. So definitely subscribe if you haven't already. I would appreciate that, only if you want to, because I think it's really important for you to find value in what we have to offer. Otherwise, it wouldn't be helpful. With all the softening demand for iPhone 16, Apple is still up 2% today. Yeah, I mean, at the end of the day, those are still reports that have come out of analysts' estimates, and Dan Ives is probably one of the ones that tracks Apple very closely. I think he raised his price target to $300, expecting a $4 trillion valuation for Apple over the next, I think, 1 year or so, and he's expecting another super cycle in Apple. He sees a super cycle in Apple if it's over 230 million iPhones sold, the new iPhones, 230 million, and he still sees that he sees, I think, over 230 million is the number really of people that haven't upgraded their phones in over 4 years. So they come into that upgrade window, and hence a super cycle is what he's expecting from Apple. But iPhone 16 was, the pre-orders were definitely lower than what we've seen before. So again, the earnings will tell us everything when Apple reports, and get ready for October 15th to November 15th. So really, it's going to be October 14th to November 15th that, in my opinion, is going to be even more crazy than what we are going through right now, because in between those 30 days, we've got earnings from all big tech, all S&P 500 companies. We've got the election. We've got the next FOMC meeting. We've got inflation numbers, unemployment numbers. And so those 2 dates, October 15th to November 15th, those 30 days, the calendar is packed. It is packed. Elections, FOMC, earnings, employment, inflation, everything. So I may have to be live for 30 straight days to cover everything. But yeah, I mean, so thank you so much, Enzo. I appreciate that very much. By FOMC start, you will reach your goal. Yes, we're expecting to hit that goal. But wow, markets are very flat. It's about as flat as it gets. Literally nothing. So S&P's flat, QQQs are flat. Let's see. So here's what to expect from the most important rate call in years. The Federal Reserve is expected to lower interest rates on Wednesday for the first time in over 4 years, actually 5 years, because July 2019 is when they actually cut rates last. Or I guess you could say that March of 2020 was also the time when they cut rates, so a little over 4 years. Reversing the restrictive measures put in place to control inflation. However, there is an ongoing debate for the size of the rate cut. Their decision on how to begin this easing cycle just under 2 months before a closely contested U.S. presidential election will likely depend more on the message that Chair Jerome Powell and the Fed policymakers want to send as they shift from the highest interest rates in 25 years rather than on immediate macroeconomic concerns. Again, over 60% of market participants expecting 50 basis points, 40% 25. Deutsche Bank says, and that's what's also interesting. It's not just the Fed funds futures and traders. It's also institutional investors and banks, buy side, sell side. It's still undecided, uncertain on what's going to happen. Deutsche Bank says, we expect the Fed to cut rates by 25 basis points at the September meeting. There are strong arguments for and against this action. While there is a compelling risk management case to support a larger move, Fed communications before the blackout period and the balance of data do not clearly argue for a larger cut. ING says, we fully buy into the argument for the Fed moving policy back to neutral swiftly and expect the Fed to push the case for a 50 basis point cut in the September meeting. However, the issue is whether the FOMC members are as certain. An economy growing at 2.5 to 3% with low unemployment, inflation above target, and equities at an all-time high suggests there will be large pockets of resistance, which makes the outcome for tomorrow, in other words, today, a coin toss. Bank of America, 25 basis point cut would send the message to markets the Fed is in control of its own message. See, this is what I mentioned. If the 25 basis point comes in, the market will have to adjust, not the Fed. If 50 comes in, the Federal Reserve will have to adjust. Really, it's the Federal Reserve caving in to market's expectation versus the other way around. It would send a strong message that the Fed is in control and not the market. That's very important. I think that's a good point. And Chair Powell could deliver a dovish message that emphasizes the data dependence and leaves the door open for larger cuts starting as early as November. And a lot of that, of course, is going to be displayed on the Summary of Economic Projections as well. A 30-day live stream. 30-day live stream. That's death sentence. Reminds me of those Korean gamers who played for a week and forgot to feed their baby. Really? That's happened before? Like gamers? I don't even know if there's a record for the longest live stream. Is there? On any platform? I don't even think... Like, going a week of live stream, and not just kind of like a live stream where you just, you know, turn it on and just walk away and there's like nothing on the screen or something else on the screen. It's where you're actually there talking or gaming or trading or something. Like, you're actually there. I don't think anybody can go like more than a day. Let me do an audio check. So we can do an audio check, see if everything is working fine. And so you guys can give me a thumbs up if there's no issues with the audio.
Out of investment grade debt.
So let me know if the audio is good.
A habit, though, of forecasting more than the Fed has done and often more quickly. So we'll watch the dot plot today. Listen to the guidance. We're going to end the day knowing the answer to 25 or 50, but begin a new debate of whether it goes down 100 or 200 or more in the next year, Sarah.
Always fun to debate all of it. Thank you, Steve. Steve Leisman in Washington. Our next guest is in charge of corporate credit at Goldman Sachs, advising America's biggest companies on their multi-billion-dollar financings. Joining us here at Post 9, Johnny Fine, Goldman Sachs Global Head of Investment Grade Debt. Always on a Fed day. Welcome. Thank you.
Thank you for having me. Great to see you all.
You're 25, right?
I am 25.
Why?
So I think a couple reasons. I think firstly, if you replay everything that's happened since the July Fed, financial conditions are actually quite a bit easier. Stocks are back to the levels more or less they were at before. Credit spreads are back to more or less the levels they were at before. Term interest rates are 30 to 35 basis points lower. And the terminal rate hasn't changed. It's just there in 12 months as predicted by the forwards, as opposed to 24 months. That's actually real easing into the economy. So I think that's point number one. I think point number two, and this is where a lot of people I think might disagree with this train of thought. I think that the Fed still has a perspective, and a number of guests have talked about this today, that 50 is generally reserved for more emergency type of action. Now, I think we're at 200 basis points in restrictive territory, so I think the Fed is well within their rights to say a 50 basis point cut is appropriate. But I don't think they've done a strong enough job as yet of destigmatizing a 50 basis point cut. So what I'd be looking for today is a dovish 25, opening the door for 50 basis points being normal course of action in the future. And then, of course, we'll run the play of, will the next meeting be 25 or 50? That'll be with us for a while.
I mean, he is going to have to do a little work if he does 25 on the dovish front to convince the markets that they're still right with the path in order to keep financial conditions from tightening, right?
Agreed. And I think that that will be something they'll look to protect both in the press conference as well as in the dot plot as well. So I think that seeing a sell-off in long-term yields will be a very undesirable outcome. My guess is that the Fed will look to try and protect the shape of the yield curve as it stands right now.
What is it? Oh, go ahead.
It kind of sounds like what Canada's put together, right? Couple 25s. Last few days, we're not averse to a 50 down the road if we need it.
Yep.
Is that a decent playbook or analog?
I think it's a good playbook. Yeah. I think the market will like that. My guess is that the market doesn't like 25 when they first see it, but when they see the dots and when they hear a more dovish tone in the press conference, I think they'll be soothed by that. That would be my guess as to how the day plays out. But I think that's a decent playbook.
We saw Steve reference, I mean, we're sub 3% by 2025, maybe by this time next year. Do you believe that's going to happen?
So Fed futures forwards do a terrible job of predicting what actually happens. I think we looked at data back to 2017. If you compare where the market thinks Fed funds will be in 12 months' time and look at where they actually were, then there's a prediction miss by, on average, 60 basis points. And so my guess is also that we won't be at that level in 12 months' time. My personal view is actually I think we'll be higher. I don't think the terminal rate will be as low as 2.75 to 3%. I think it'll be higher. I think that the reality is that the things that we're concerned about today, in particular labor market, I don't see that as being a huge headwind for the U.S. economy. It's a headwind. But I think as we get into the easing cycle with some 25 basis point cuts, potentially opening the door for 50 basis point cuts, I actually think that we'll be on a much better glide path, and I don't think the Fed will need to go that deep that fast.
Let's get back to corporates for a second. So what do you do right now? I mean, if you're a treasurer or CFO, do you hold off on refinancing? Do you hit the market because rates have already weakened a bit and perhaps, as you pointed out on the long end, may not come down that much?
I think you've already seen the reaction function in September. We've had an extraordinarily busy month already in the investment grade financing markets. Year to date, it's the second busiest year ever, bested only by the big COVID boom that we saw in 2020. And that's with spreads at tights and with yields at lows. So if you think about the real winners from all of the volatility that took place in August, it's actually corporate America because they're able to finance at lower yields than they were prior to the July Fed. So moving in advance of that, and that's been the playbook all year, moving in advance of risks emerging at the end of the year, in particular with the election, that's been a huge boost to activity. It's a huge boost to the leveraged finance activity as well. Almost 2/3 of the entire leveraged loan market has repriced this year as spreads have compressed. And you've also seen a much better level of activity in the equity capital markets as well. both in global ECM, it's 40% higher year over year, and US IPOs 70% higher
Yeah, although
year
that's
over
not
year.
saying much coming off the base it was.
It's off a low base, but I think it builds in both markets, both leverage finance and in the IPO market. It builds for a stronger outlook and backdrop when we think about what 2025 might be.
Good for the bulge bracket banks. I am curious, Johnny, what you're hearing about the election and what companies are anticipating and how it might change your market.
So I think that probably the most important part is what's going to be the impact on the labor market, and that's largely going to be driven by immigration policy. That's really a function of who's in the White House as opposed to necessarily who has control of Congress, because a lot of that can be executed via executive order. I think both administrations are hawkish on immigration, and so I think we're going to see a much better balanced labor market in either instance, but clearly a tighter labor market in a Trump administration compared to a Harris administration if he follows through on some of his pledges with respect to deportation, immigration more broadly.
So higher rates?
I think that probably leads to a slower path of cuts because we have actual tightness in the labor market as opposed to concerns overall. And then, of course, with respect to the rate direction overall, a lot of that will be a function of fiscal policy. I would say both candidates are likely to be expansive, but that's going to require control of Congress. So either a blue or a red sweep is likely to put upward pressure on yields overall.
Johnny, great having you today. Thank you very much
Great to see
for
you.
all the color from the trading desk. Johnny Fine of Goldman Sachs.
After the break, it is the first airline merger in 6 years. The CEO of Alaska Airlines is going to join us at Post 9, closing that deal for Hawaiian. In a moment.
All right, so case for 25, and not so much for the 50. All right, guys, so looks like we didn't hit our goal. That's okay. We're going to be live again in a couple hours. And again, thank you so much for joining. Really appreciate you all. We're going to be live in a couple hours at around 1 p.m. Eastern. So 1 p.m. I'm planning to go live again. An hour before the statement release, the summary of economic projections, everything. We'll take a look at all the possible outcomes, all the different expectations from the markets. We'll take a look at the liquidity tools, the put-call ratios, the volatility, everything. So we had 1,200 votes altogether, 1,222. So once again, thank you so much for participating. And the next poll that we're going to do in the next live stream is going to be the market's reaction post statement and SEP and press conference. Markets higher, lower, or flat is going to be the next poll. So join us in a couple of hours. Again, thank you so much for tuning in. Really appreciate you all. Subscribe if you haven't already. Thank you so much for joining. Drop a like. And also, if you want to join our community, I'm going to jump into our Discord for a little bit, send out some alerts, engage and interact over there, and get ready for one of the biggest decisions of 2024. Happy investing. I'll see you all.